Summit this past summer, and he's been in the industry for quite some time and has lots of really good nuggets he can share with us today. So everybody give it up here for Sam Sharp.
Woo-hoo. Thank you. Appreciate that. Thank you. Yeah, here we go. Let's try that again. All right. Let's see here. I guess I can leave this right here. I was going to move it up a little bit, but I think we're okay. Good afternoon, everyone. How are you? Good? So interestingly enough, I had prepared a little bit for this. And, to prepare, I went back and reread the little bio clip that I gave you to promote this. I'm like, well, what am I talking about? I don't know. What did I say I was going to talk about? And so I went and I prepared something based off that. And the mechanics of it was initially talking about buying a home that would be geared towards first-time home buyers. Now, had I thought for just a second, probably even just taken myself out of that, I would have realized that I'm willing to bet we don't really have any first-time home buyers here. Anyone? Yeah, you look young, so I'm looking right at you. I'm sorry. I should have asked you, are you a first-time home buyer? So because of that, I think I'm gonna pull an audible and I'm gonna change things a little bit because I don't know how much you want to hear about what I was gonna say about that, really. I don't think it's relevant. So that'll take us to a little bit further along through. So Sam Sharp, Executive Vice President at Guaranteed Rate, local lender, national lender, but born and raised here in Chicago as far as the company goes. As stated, I've been in the lending industry for 22 years. And, well, I guess some relevance towards the initial story I was going to tell. So in 2004, I'd been in the industry for 3 years or so, and I decided I wanted to buy a home. All right, I'm gonna buy my own place. Now, it wasn't because of a clever rent versus own schedule that I had created for marketing purposes. It wasn't because all the things that I put out there to tell people why you should buy a home, it really had nothing to do with that. I just wanted a really cool place. That's it. I grew up in Colorado, very poor, I guess we'll say, it's putting it lightly. And I just, at this point in my time, I was in my career, I was doing well, and I was like, I want something. I want it, and I found it too. I found a really cool duplex up condo in the Ukrainian village, bought it in 2004, and I sold it. I closed on the sale of that in December of 2005. Now, if you think of the timing, so I closed on selling my condo in 2005, and I closed on buying my single-family home, which was next to the trail just over here, in 2006. I don't know how many of you are thinking about where I'm going with this, but it was a different world, right? When we got into 2006, things took a drastic turn. I actually remember, so when I was selling my condo, this is insane. I remember just looking at it, and I was in Ukrainian village, and all of a sudden I started seeing properties pop up because, of course, I did not turn off the search. I had an agent. I worked with an agent. They had the search engine set up to send me properties, and even though I know better, I still kept looking, just kept looking. And then I saw this place that was amazing. It looked like my place was a duplex up. Only it was actually in Wicker Park. And in 2005, Wicker Park versus Ukrainian Village was a different world. Like that was better real estate. And it was on the market for about $30,000 cheaper than my house, than my condo. And I was just like, oh my God, close, please close, please close. Because, we're starting to see the writing on the wall and the market's crashing. So, and it did, it closed. And then I bought my single family home over here in Logan Square. Now, I got lucky, right? That wasn't on purpose, And it's so funny because it's not that I was making history, but it's a saying that I heard earlier is when history is being made, you don't realize it in the moment, right? You don't understand what's happening. Hindsight is 20/20. Insert whatever type of neat saying that makes you feel good. I love neat sayings. They make me feel good. And I got very lucky because I did look to buy a home because I found a place that I wanted to live. Now I also got very lucky because I sold it very quickly for a lot more than I paid for it before the market crashed. And I've always been able to stay out in front of things, not because I was thinking. Had you been first-time home buyers, I would have segued at this point to tell you about how to prepare for buying a home and things you should think about. But I will say that it has some relevance towards my personal involvement and understanding as an investor and how I came into that world, because I do own several multi-units. I have up to 27 doors. And it was my retirement plan is what I looked at. And it was one of those things where you kind of stick, you kind of go with what you know, right? And for me, it was a matter of, in hindsight, looking at how mistakes could actually lead to something and how there's something good behind things that you think are just terrible. So I had thought I was really smart when SiriusXM, when they were going to merge, right, and XM radio, and I was like, oh yeah, I love satellite radio. I'm a musician by trade. This is what but once upon a time, before the mortgage industry, all I used to do was tour the country and play music. This is what I did. And so I'm like, this is going to be big. This is going to be big. I'm going to buy some stock. I'm going to be a trader. I got some money in my pocket. I need to invest, right? What am I? I'm going to invest. Buy some stock. I bought SiriusXM, and it was so funny because I'm like, all right, and I split $2,000 into stock. $2,000. Now I've got to tell you, it was a lot of money for me. I was like, okay, this is a big deal. I've never done anything like this before, but I'm gonna give this a go. But I do know one thing. I'm like, again, those clever sayings, right? It's not timing the market. It's time in the market. So I just set it and forget it. I put it in an E-Trade account. So I bought this stuff. It's like E-Trade. I'm not going to talk about E-Trade. So what I didn't realize, though, while I'm not paying attention, because I'm busy trying to figure out how to do mortgages and how to buy properties and do things and help people in this wonderful world. Meanwhile, that stock just tanked. I mean, it got down to like 2 cents a share is where it was at. And it got down so low that E-Trade actually liquidated my stock and sold it because I owed them money. So I got a statement one time. It's the first time I ever get anything from them, ever. They never reach out to me. I never find anything. I never hear anything until all of a sudden I owe them money. I'm like, what do you mean I owe you money? You have like $2,000 in my money. Actually, sorry, I bought $1,600 worth of stock and I left $400 in the account. And they ended up selling my stock after they drained the $400 to maintain the account. I was like, oh my God. Set it and forget it, and that world didn't work. I'm just going to put it there. And so I thought, wow, investing sucks. Like, this just sucks. I suck at this. I'm just gonna keep doing mortgages. I'm good at this. I'm making good money. I don't need to think about it. Well, fortunately from there, I started to realize that wasn't a good theory, and I was like, all right, stick with what you know. What do you know? You know real estate. Like I know these up and coming areas. Being a drummer, right? So I bought my house here in Logan Square, not because I thought Logan Square was going to be the up and coming hot neighborhood, right? Although that was part of it, that was definitely underneath there. I bought it because that's the only place I could get a single family home I wanted a really nice house. Brand new construction. Only place I could afford to buy a really nice house. Again, this was 2006. Logan Square looked a lot different. This is not here. And it was interesting, because you go through that and you try to stay out in front of things. And I started thinking about it. I'm like, all right, well, I'm pretty good at figuring out these marketplaces. We were just talking about this. And I started looking out there. And I think a lot of you probably know Bree Schmidt, right? It's funny because me and Bree, we used to butt heads about my investment strategy, about buying multi-units and what I thought. She's like, that's not a good buy. Why would you buy that? Don't buy that. And I had a different strategy. See, my problem was that I was cash heavy. I was saving a bunch of money from working. I wasn't spending it. And I was in a position where I was like, all right, well, I got to invest my money. So I was like, this Portage Park area looks kind of cool. It's 2009, right? Bought my first 2-flat with a garden apartment, we'll call it. And it was $265,000 for that property. And I renovated the units and rented it out. Was my first place. And because when I started looking into it, I thought, okay, so the people are paying $1,200 in rent, like these two $1,200, and $750 in the garden apartment. And they're still there too, actually. The tenants in the garden apartment are still there. And it's so funny because I just started thinking, like, okay, so under $300,000 for this, and they're paying that amount in rent. Meanwhile, in Wicker Park, I'm going to have to pay $550,000 for the same property at that time, which sounds, well, wow, that was a really good deal then too. But the rents were the same. So I did the math. I'm like, okay, I'm going to leverage my cash. I'm going to buy in large down payments. I buy my properties. I put 30% down, and I put them on 15-year notes. Now that's where me and Bree started to disagree, because Bree was like, well, why were you well, you're leveraging your cash or putting too much. And my argument was like, I'm too cash heavy. I'm like, if I keep my cash, I'm going to buy some stock like an idiot and lose all my money. Like, don't you understand? I don't know what to do with this. This is where I'm parking my money. But for me, I was like, well, I'm going to put this money down, and my properties are breaking even. Like, I'm not making money, but I didn't want to make money. I didn't need a property cash flow. I didn't need to see residual income that I could use. So I'm like, okay, this works for me. I like this model. I'm going to stick with it. He's like, that's a terrible idea. Let me talk to you about it. And going through and looking at it now, I've gone on to buy a lot of properties since then, following that same model. And the best part about it is like, well, it's 2023, right? Like, I'm almost free and clear. Every year, I was buying one a year, and every year, the plan was I was going to buy 30 properties, one a year for 30 years, and in 30 years, because when I first started, I will take a step back. I did buy it under a 30-year fix. When I first started, I was like, I'm going to do 30-year fixed mortgage, one a year for 30 years, and then that will be owned free and clear, and every year after that, another one will be owned. And that's my retirement plan. This is what I'm going to do. And then not too long after that, I bought my next property, and then I refinanced into 15 years. I changed it. I'm like, all right, I'm going to buy 15 in 15 years, and I'm going to retire early, and this is going to be amazing. Because, of course, you can predict the future in this market and in this world. So following through that strategy, though, it worked out really well, because now those properties are almost free and clear, right? I put them all in 15-year notes. I get the mortgage statements, and I don't know which property it's tied to anymore. Like, I used to make fun of my clients when they would try to tie their mortgages to the other properties they own. I'd be like, how do you not know which mortgage goes to which property? I'm that idiot. I really am. But it's incredible, though, because now the cash flow, right? Now rents have risen. Now rents have gone up significantly. The property values. If I told you, to buy a property in Portage Park, a multi-unit for even $300,000, you'd be, running to get that. Those properties are more than doubled in value, and it's just amazing at the plan and how that works. Now, for me, I went with what I knew, and I went with what worked. Now, that obviously doesn't fit everyone's model, and unfortunately, it doesn't fit most people's models. Not most people are sitting around going like, what do I do with all this money? It sounds like a pretty, as I say it out loud, it kind of makes me sound bad. That's not the way I mean it. But the reality is, when you're looking at that, you have to start to figure out ways. And this was Bree's model. How do you leverage your cash? And I agree with this, right? I can find data and information to support pretty much almost anything, right? Two sides of every coin. It's like you can find enough to support either side of the coin, and they're both right. Just depends on which one you're confident in and which one you follow through and which one is consistent. So you have to identify as you start to look. You're investors in this room. You're buying properties, and you start to think about that. So from there, you start to identify, okay, well, what am I planning to do, and how am I going to finance these properties? How many do I want to buy? What do I want that to look like? How long am I going to hold them? What am I going to do with those properties? In my example, my properties now are not my properties. They're in a trust. They're for my kids, right? They're for the children. This is what we do. I'm like, okay, so this is their retirement. It's still my retirement plan. The idea now is that these properties later will generate the rental income, which will be the money that our family will live off of. And then when we pass on, they're in the trust for the kids, and they're an appreciating asset that's now generating revenue that then goes back into the trust. Because I don't know. I'm still debating if I ever actually give the kids anything. We'll see. They're 6 and 4, so I got time. Well, I hope. So you start to think about those strategies. Now, going through and looking at that, who has more than one property? Who has more than 2 properties? Got more than 5 properties? Right here. Right? He's speaking next. When you're going through and you're looking at it, when you're thinking from that first to the 5+ properties, you're thinking about it in certain situations, you have to start to think about how you're going to get where you want to be. How can you get the most bang for your buck and leveraging your cash? And that's where the financing side becomes very important, right? The house hacking models, obviously, it's a big thing, right? It's a term, it's a buzzword, it's out there. It's about as popular as the term content. Everyone's talking about house hacking. And the idea now is to figure out, okay, well, how do we purchase properties with little to no money? How can we then continue to wash, rinse, and repeat and do this over and over again? And there was a time frame where we used conventional financing that led to FHA financing, that led back to conventional financing, and then the loan programs changed. Unfortunately, in the lending industry, the only thing that is consistent is that it's constantly changing. Now, I will tell you that coming up, I'm sure you've seen tons of videos out about Fannie Mae going and allowing for 5% down on owner-occupied multi-units, which I'm super excited about. Like it's great. I'm not just excited though because this is going to help my clients and it's going to help people who are sitting in this room, right? If you're going through that model, I'm excited because this is a very interesting time, right? The market that we're seeing right now is very different than anything I've seen in 22 years, and it's probably very different than what most people have ever seen because we have a shortage of inventory, we have higher costs, we have higher interest rates, we also have a lot of economic uncertainty, and people are in a very strange place. So I get excited because I understand when I see these programs. Back in 2008, when we were coming out of the crash, that's when Freddie Mac's Home Possible lifted their income restrictions, right? And what did we have? We had 5% down multi-units on conventional financing. Why did that happen? Well, the headlines were because they wanted to help people in underserved areas. But I mean, take a step back. We're going to lift the income restrictions to help people who don't make enough money. Like that's not what happened. What really was at the heart of that is Freddie Mac needed to lend money. It was things were crashed. Fannie Mae and Freddie Mac were like, now they got taken over by the government. Government's a business. If you think it's not, I'm sorry, but I don't even think there are two sides to that coin. And it is a business. And when you start to think about it, when that business is looking for clients and it wants to lend, that's actually a really good thing because they're going to do what it takes to make that money attractive, to make it cheaper, to find incentives to get people to find ways to buy homes. And that's what we're seeing now, right? We're seeing 5% down multi-unit come back into play. Why? Because they want to lend money. Fannie Mae wants to lend money now, which is great news for everyone sitting in this room because it starts with programs like these and then it becomes even more lucrative as they start to realize that there's not enough people to just buy these as primary residences. Now you can start to see some, maybe we'll start to see some movement on the investment side and what that looks like. I don't know. That's still a very, very tough gambit as far as they're concerned. They've been the GSEs, which is Fannie Mae and Freddie Mac, are staying very clear from that. But fortunately, there are some portfolio products out there. So I think that right now, as we go through and we look at buying investment properties, and we look at investing our cash, I mean, is anyone to the point where they've gone through with house hacking or they've bought a multi-unit, they've been living in their multi-unit, and they don't actually want to live in the next one? Ooh, that's good. Yeah. You all have something to think about soon. You know, you've got obviously someone else that's going to have an opinion very soon about that. So unfortunately, you got a little time of that. Well, that's good news though, because if it, and the camera can't see that, but no one raised their hand, which means that you're going to be able to take advantage. You should be able to take advantage of 5% down conventional financing right now, because there's no restrictions on that according to current guidelines. Now, I will tell you this. We don't know what those guidelines are. I wish I could share with you and tell you right now this is what this is going to look like, and I don't care what you see on Instagram. There are a lot of lenders out there who are putting things out about this program. I have a lifeline to Fannie Mae. I tell you, I help in my career. I've made big strides with helping both Fannie Mae and Freddie Mac rewrite their guidelines. I have a direct contact to how they operate, and I know for a fact that we can't actually use this program yet. The automated underwriting system that will be required to use this program will not actually run until after November 18th. It will not recognize it. Hopefully here coming up in the next couple of weeks, we'll have some guidelines though on what this means, like if you own too many properties, right? Because that could be very realistic. They may come into play and say, okay, 5% down works unless you have up to 4 financed properties. After that, we won't finance anymore. That's fictitious. That's not true. That's just something to keep in mind. So keep your eyes out for that, because the conventional item and the benefit of this is this will allow you to purchase a property, less money down, should be more favorable interest rates, which are that's a subjective term right now. Obviously, money's very expensive. And going through and looking at that, I want you to consider your strategy. I want you to think about what are you going to do with that property? How long are you going to keep it? And what do you think is going to happen in the marketplace? I've been having interesting conversations with my clients over the past few weeks, and this is great. So you come to me to borrow money, and you say, I've got a contract, and I'm going to buy this property, and let's just say that you're putting 20% down or something. You're buying a different property. My conversation with you would say, okay, great. I think that you should pay 4 points and buy down your interest rate. And you're going to be like, yeah, I'm not going to give you $30,000. Like, I'm sorry, that's a terrible idea where I'm going to refinance when rates go down. And you might be right. And I've been believing that myself, right? I have a program. I call it Refi Ready. Every client I close gets immediately enlisted into it. And it's basically a tracking system that shows, based off of the average appreciation in the area, their property value, their amortization schedule on their loan, so that I know where they're at all times. And I get, the software tells me you can lower their payment by $100, give them a call, right? So I've been using this. I've been actively pushing it. But when you start to look at the coin and you look at both sides, you're taking a bet that interest rates are high and that they will come down. Because why? Because we haven't seen rates this high. But we have. And the last time rates were this high, 1975, was when rates went up and they got into the 8% range. They did not go down for 18 years. 18 years. And in that time frame, they spent the majority of it over 10%, and a big portion of it 13, 15, 18%. These are those stories you hear about. And this isn't that, yeah, but property was $9. It's not that argument. It's good to learn from the past. I mean, I can tell you this. I don't claim to be smarter than the market. I don't really think anyone is. I do like history, though, and I do like to see how certain patterns can repeat themselves. And when you look at it this way, you're taking a gamble. You're taking a bet either on rates going down or rates going up. And when you think of the fact that in 75, interest rates were at 8%, and that they continued to go up for quite some time, there could be a case made for interest rates going higher than we see right now. I do think they will. I don't think it's outlandish to think that we will see 10% in the not too distant future, and I don't think it's outlandish to think that it may stay there for a while. I hope I'm wrong. It's not a bad problem to be wrong with, but at the same time, it's time to have those conversations. When you're buying that property with 5% down, you're looking at it. If you want to hold that in the long term, you want to start to look at what's your break-even point. When you're talking with your lender, I assume everyone here has established relationships. When you're having these conversations and you're talking to someone, what most lenders will do is they'll look at the break-even point. If you pay $5,000 up front and you're going to save $100 a month, then it will take you 50 payments, right? So that would be the math. You're like, okay, 50 payments, it's under 5 years, this is great. But what they're missing is the amortization schedule. When you borrow money on a traditional financing, right, whether you're using a 30-year fixed or a 15-year fixed, any of these models, if you're buying conventional money, because we're talking about Fannie Mae here, right? When you borrow that, there's a set amount of principal and interest that goes towards every monthly payment, okay? That is drastically different at a lower interest rate. Just so you know, the amount of interest you pay on a home at 2% versus 4% is not double, right? When you start to get down to lower percents of interest, the way the interest is calculated, it's not that way. And the difference between 4% and 8% is more than double. So it's really, when you get into these upper percentages of interest, it's actually drastic on what you're paying. So what happens is in most scenarios right now, if you were to pay 4 points in this scenario and you think I'm crazy, your break-even point, though, is usually about 36 payments to 38 payments. It's been segueing between the two, because what's happening is that amortization schedule, if you get the rate down to 6.5% versus 8%, your amount of cumulative interest that you've paid over that 36 to 38 months is significantly less than the higher interest rate, coupled with the lower monthly payment. So what happens? You break it even after 3 years, and then from there, you're saving tens of thousands of dollars. If this does, in fact, go for a decade, if this does go for longer than that, then you've just positioned yourselves very well. Now, if I'm wrong, and you were my client, and you come back to me in 2 years, and we do the math and say, and talk to people, say, let's have that conversation. Like, okay, well, you fell short recovering $4,800. Like, you paid $4,800 in this gamble, and you lost. But what if I'm not right? And that's like, you have to take your risk tolerance. You have to think, what works for you? What works for your investment strategy? Are you going to put $2,000 with E-Trade and then lose it all, right? I did. That's me. That's how it goes. That's also why I use 15-year notes on my loans as well. Truth be told, I started because I'm a set it, forget it kind of guy. I prefer to focus on one thing and move on, do it and move on. So you have to think about your risk tolerance and what will work for you, but start to think about this as you go through and you start to look at these properties, because a lot of what we're thinking in our financing strategies up front is we're thinking, okay, the more money I can leverage, I don't want to put too much money into this property because I want to buy another one in a year, right? You want to keep going down that path. That's not a bad idea, but make that part of the idea, make that part of the conversation. What do you want to do? How do you want to do it? How do you want to get there? And as you're starting to consider your finances, talk to a professional about what you're going to do to get there. Doesn't matter if it's me or whoever it is that you work with. Just talk to them and start to have these conversations, because it could very well put you in a place where you're not going to find yourself wishing you didn't buy that stock. That make sense? So I had that whole first half was going to be about buying a home and all kinds of stuff, and then this half was going to be a little bit about the investment strategy. So, that was a lot of what I had going up there, because I feel like people in the room already know about FHA financing and putting lower down payments, because it's been our go-to for the past few years, right? Fannie Mae and Freddie Mac pulled back. FHA is what we use to get in. Great. Now conventional's coming back into play, so now we have that. A lot of the portfolio products that we've been using recently that did 5 and 10% down, they weren't government loans, they weren't conventional. They're not really liquid right now. I don't know if you've looked into these in the past, but they're pretty much kind of pulled back. They don't like the risk in the environment right now. So this means that you're going to be, since you're all talking about living in your property, this Fannie Mae program is going to be what you're watching for. Yeah, how many people in here currently have an FHA loan on the property they live in? How many people have an FHA loan on a property but they don't live there anymore? Okay, so you still have that. Now, you said you were talking about did you say Baton Rouge earlier? Like Louisiana? So you're spread out, not just obviously concentrated in this area. Your FHA loan is in Illinois? Yeah. Okay. So you're going to be tied up with that, right? But for those of you who don't have an FHA loan and you have this Fannie Mae program, if we were having the same conversation along these lines, that's what we start to look at, is figuring out we're going to run a cost analysis based on FHA versus conventional. And chances are that you're going to, depending on the guidelines on the conventional, you may take advantage of it, but you may not, because we'll have to find out what makes sense with that property. But it's good. So the basic principles of stacking those properties and financing them is taking advantage of the properties that do have lower down payments, because they can allow you to use your cash towards improvements on the property. You can use your cash towards, saving. That house that I bought in Logan Square, I always remember, I was so excited. We sold the condo, I bought the house. The day I closed, I had a TV delivered. This is amazing TV. I was super excited about this. And my drums. That's all that was in this house. That's all there was. I had waiting for everything else. And I went there, and I was gonna use the TV. I hooked up. I had a Blu-ray player, because this is 2000. This is how it was. And I just couldn't wait to see this TV. And then I sat down, and I couldn't see the damn thing because it was 3 p.m, and the sun was just blaring through. It's new construction. There was no window treatments, right? I had no idea how expensive that stuff was, because my condo before that had window treatments. I didn't even think about it. So maybe you're leveraging your cash because you need to buy window treatments, or maybe you want that TV. I don't know. I'm cool with that. I like neat things. But the idea is that from a financial standpoint, you're stacking these properties. You're using your cash so that you can free that cash up towards either other investments, future properties, maybe paying 4 points when you do buy that property, and starting to get in line with that. But start to consider the options, make a list of what those options look like, make a plan, and then be ready to pivot when that plan changes, because they pull the rug out from underneath you. That's kind of all I really prepared to talk about. I'd love to answer some questions. I feel like we've got some pretty smart people in the room. So.
Do you have any commercial loan products that you can?
I don't actually, no. I think that commercial financing is more than a full-time job, and I also feel that when done right, residential financing is more than a full-time job as well. So I always, in 22 years of doing this, I always stayed away from commercial financing, which is
4 units and less.
4 units and below, yep. Which is
the Fannie Mae product we talked about owner-occupied product?
It is, yes. Now, that's one thing I know, is that they're not going to go 5% down on that, but I am curious to see what some of the other guideline changes. They won't tell me anything. Nothing at all. I can't get anything.
It does seem like they've moved to what, I'm old enough that I remember when the VA loan, you could use it as many times as you want. It wasn't, you used it and then you had to have a pay down, and then you could use the equity that you had in VA.
Right.
And use up that. And it sounds like from the statement you made that this product with Fannie is going to be similar in that if you already have a Fannie, they're not gonna do another Fannie unless that one's paid off.
No, I think that if they follow guidelines, so I'll just use a similar product, the Home Possible loan when we would utilize this. They volleyed between you could own one property, and then for a while they changed it. You had to be a first-time home buyer, and then things got a little bit tough, and then they switched, and you could own as many properties as you want. Those are the types of guidelines we're watching out for. Right now, I have no reason to believe that they would have a limit on how many properties you have, how many times you could use this loan program. It's not being, at least in its initial presentation, it wasn't based off of underserved areas, income restrictions. None of that has been listed. It's just been, we'll now allow 5% down on a multi-unit if it's your primary residence. It's about all. That's literally all we know on it, even though you're going to see, again, you'll see people put stuff out. 5% down this way, but 620 credit score. I'm like, and these are some respected lenders too. It's actually kind of sad to see. I'm like, why are you, this is clickbait. I'm like, why are you doing this? What if I come to you, I actually called one of them out because they're a friend of mine. I said, great, I'm ready. Let's do it. Lock me in. Can you lock the interest rate? Oh, sure, we can do it. Like, really? What are you going to do on the 18th when you find out that it doesn't work? And you made a commitment to me, and I'm under contract, and I paid for an appraisal, and I paid for an inspection. I'm like,
Yank the rug out.
you're going to yank the rug out. I'm like, and I even told him, like, come on. I'm like, you're better than this. Don't do that. Don't sell something you don't have yet. But I think that the program will not have restrictions. I think the biggest hit that's going to be there, though, is that loan level pricing adjustments. This is what impacts your interest rate. I don't know how many of you remember, my concept of time is terrible. I had to actually consciously figure out when I bought my first place and when I bought my next place for today, so I could think about it. I was like, when was that? Fortunately, I have the crash as like a big reminder. Just like we use the pandemic. Everyone always use that as a timeline. It's like living by the lake. I grew up in Colorado. Everything's like by the mountain. You use the mountains to gauge everything, right? Here you use the lake. It's like now we use the pandemic to set our timelines and understanding, right? So we'll see what I lost my train of thought too because I was kind of getting giddy on that actually. Sorry.
I have a question. Historically, how do you see the spread? Like, you know how the mortgage rates are, 30-year mortgages are calculated, or the prices are based on a 10-year treasury plus some spread.
Sure.
That's what usually.
Right.
So now if we see the treasuries around 4.9, mortgages are 8, about 3% spread.
Right, you're seeing a bigger
3
spread.
points. In the past, historically, I'm hearing that it should be at 1.7 spread.
Right.
Is that true? And why do we see that large spread now, on the 30 years? Plus, I want to understand from you, is selling back, the mortgages to, as securities, is this still going? Are people buying these?
Right.
So can you elaborate on that a little bit?
So it's funny because some of the answers to your questions are within your questions.
Okay.
So the reality is that the 10-year is just a general guideline, but it is not the driving factor as far as where that goes. So that spread can change because it's not exactly correlated. It's just been a good baseline that we use for gauging where interest rates will go. So that's why you're seeing this pattern. There's been times where the treasuries have dropped so far and interest rates wouldn't go down. We're on the opposite side of this. We're like, rates should be so low right now. Why are they not low? And this is going back to after the crash, actually. So it's not always directly correlated. What is a big driving factor are those mortgage-backed securities and where they're selling them, right? So what's happened and where we're at right now is that there was a massive amount of treasuries that were purchased by the feds, right? Open market committee, the government goes through, they bought all these treasuries, and that's why interest rates dropped, right? So if you go buy a bunch, then they drop, right? Now no one's buying them, so the interest rates just keep going up and up and up. So they're actively trading them. So now we watch to see the securities tradings to see what they're doing to try and have a better understanding of where interest rates are going to go. So right now, they're still being purchased, and when you see issues, economic hardships, then that's actually, unfortunately, that's why it's better for interest rates, is because it's a flight to safety, is what they call it, right? People take their money out of the stock market and they start buying mortgage-backed securities again. So, but it's interesting right now when you think for a fact that like 42% of the homes in the U.S. are owned free and clear. 60-something% of the mortgages that are opened are 5% or below right now. So mortgage-backed securities are in a very strange position right now, right? Because they're and it'll be, I think the other fact that we'll see, it'll be interesting to see how the non-QM space. So non-QM is the new word for subprime. it's really not subprime. It's not anywhere near that drastic. I'm being very extreme on that, but it really is. It means it's non-qualified mortgage. That's what QM stands for, is qualified mortgage. And it's interesting to see as DSCR loans and all these products come about, where are they getting sold? Who's buying those? And do the people buying them know what they're buying? It's interesting to see. We'll see how that performance rating is, because if you think about a loan that's based off of only the performance of the property and the rent, if people can't pay the rent and that person couldn't qualify to pay the payment on their own, that doesn't take a genius to figure out where that's going, which is not bad for you, because then that property goes onto the market and we start to see more foreclosures, and now we have some liquidity in there. I mean, one of the things that you have to keep in mind is that the reason why it's so hard to find a property right now is because there's so many people looking for a property, which is not because I'm out here talking. It's because in 1990, the birth rate was so high. You go back and you look at the history of the birth rate in the US, and you watch a chart, and you get up to, I wish Jason Wagner was here from, 'cause he would have an awesome chart for this. I love that guy, actually. And but if you look at the charts, you'll see that in 2009 it peaked hard. It was like for about a 5-year. And if you follow that trajectory of how many people are in the open market looking for homes, that's going to continue for a decade. You've got 10 years ahead of us. That's also why I'm looking at those conversations about where interest rates may go, because the supply and demand is going to continue to be a problem. It's yes, we're gonna put videos out on Instagram. We're gonna put videos out to tell people, like, when rates drop, what do you think is going to happen? And we're not wrong, unless people lose their jobs, and then we might be wrong. But we've got a very interesting balance. It's a balancing act right now, because we're talking about investing in properties. Now let's focus on rent. It's becoming unaffordable for people to rent homes, right? For us as investors, that's great when we're like, oh, we can raise the rents. Tenants moved out. I have just had someone move out. They'd been in the property for 6 years, one of my other places, and I couldn't believe it. I mean, I put some money into it to refresh it, because I didn't when I bought it. It was like ready to go when I bought it. It wasn't great, but it was fine. And so I just put some money in and made it nice. And my God, I was getting $1,250, and now I just rented it for $1,900. Like, wow. And they were stoked. They fought over it. And when you look at that, it's like, well, but a dollar can only go so far. People only have so many of them. Right now, this is data, right? This isn't Debbie Downer. But statistically, there is the highest level of credit card debt that we've ever seen. Now, you could also keep in mind that a dollar is not a dollar anymore because of inflation. So, of course, it's higher because what it's worth. Could say that savings, people are living off their savings because deposits are down. Right now, it was a few months ago that it was like 27% down year over year of the amount of deposits going into banks, which is why banks are tightening up on what they're lending, because they have a balance. How much they bring in affects how much they can lend. But you could also say that that's not taking into account how many people are putting their money into money markets or crypto or any of these other assets, right? So I personally am watching that closely to see how that correlates, because at some point, if the money's not in money markets and crypto and other places, and savings are getting drained, and then people are working 2 jobs just to try and pay their bills, well, now as an investor, we start to have a bigger concern even than the pandemic, where people are not going to be able to pay our rent, right? And now I'm not going to charge someone $1,900. I'm going to be going back to trying to get $1,200. So you want to think of that in that plan too, as you're stacking your properties. What's your installation? We were talking about it earlier when the pandemic hit. That I paused. I closed on my last multi-unit in 2020. At the beginning of it, it was January of 2020, and then I paused because I was like, I don't know if all of a sudden I'm going to be in a position where no one's going to pay me rent. What if the government tells everyone they don't have to pay rent anymore, and they all decide not to? That's it. I had only one tenant who had any issues with paying rent. They're on a payment plan right now. They literally got another job to create a payment plan to pay me back. I was just like, but I mean, it's been years.
The program will have a self-sufficiency test?
No. So that's one thing that I can say with full confidence, and I could, I guess, be wrong because I don't know. But there's never been a self-sufficiency test with conventional financing. That's for FHA. I will tell you this, though, neat little trick for self-sufficiency. If you are using FHA, I'm just looking at you when I say 4 points. It's not like I really want you to. It's just you've become the person I look at. So I just want you to know that. We've been using that for self-sufficiency, buying the interest rate down. Not a temporary buy down, because a temporary rate buy down is still qualified off the full interest rate. But if you buy someone's interest rate down, we've been able to pass self-sufficiency, right? And in some cases, we were able to actually just get the credit from the seller. Seller gives back 4%. We used it. Actually, they gave us the full 6%, and we used a big portion of that to buy it down. We actually used in one that I just structured with Bree. Actually, we structured it to where we bought the interest rate down to pass self-sufficiency, and then we used the remainder of the credit to buy out the upfront mortgage insurance premium. So it was and that client's going to be doing really, really well, because they got a really low interest rate. FHA rates have gone up. They don't have that upfront mortgage insurance premium, so they didn't lose that equity up front. It's pretty cool.
So can you elaborate on this process, like with numbers a little bit, about the buying down, how it works?
Well, so basically you pay an upfront cost to get a lower interest rate, right? So let's say at any given day the interest
Lower
rate.
interest rate forever?
Yeah, it's permanent, right? So let's say interest rates are 8%, and if you were to pay 4% upfront, this is 4% of your loan amount, not the purchase price, which works well because seller concessions are based off the purchase price, right? So 4% credit from a seller is higher than 4% buy down because you're borrowing less than the purchase price. But basically you pay an upfront cost, and that will allow for a permanent interest rate. You're basically, when you close, your note will have the lower interest rate. You're paying the margin to the bank for the cost of the money. You're just giving it to us up front in a way. So some people will be like, hey, you're just paying it in advance. Why do I want to give you my money in advance? It's like, well, because at some point it could actually become beneficial, and you can't go back you can't take it back. You can't close and then take it back. You have to do it up front. So you're taking a risk. You're taking a bet. You're betting interest rates will not go down. Not a bad bet, though, when you think about it. 6.5%, we're at 8%. Now, I will tell you, because I'd like to just, again, always looking at both sides. I mean, it was 5.875 in February. Interest rates were lower than 6.5%. So things could move quickly, but I think it's unlikely. I think that if interest rates do start to come down, and I could be completely wrong on this. I'm wrong all the time, so hopefully I'm not, or I don't know. But it seems like it's going to take a pretty big delta to get to where someone would refinance below 6.5 anyway. You're not just saying rates are going to be at 6.5. You're saying they're going to be lower than that, and you're going to refinance that. And even if they went to 5.875, would you really consider refinancing at that point? You might. I might convince you, but because I'll give you some data.
How many points the buy down is? 2?
It's anything. It could be, yeah. So a point, when you hear someone say it's a point just stands for 1%, right? But technically a buy down could be 0.568. It could be 1.1. It could be whatever. And what you're looking at is banks set their interest rates, and you just have interest rates, right, going from 5.875 up to 10%. They're not really that vast, but it's a scale, right? It moves in eighth increments usually. Sometimes it's a little bit differently. And on that, you have the par pricing. That's the rate you can get, right? It's like, okay, well, this is 8. 8% is there. Now, below 8%, it's a cost. The margin there, it costs the bank to lend the money. So you have to pay for it. So when you're buying the rate, you're paying the discount to get there. Now, I mean, is everyone familiar with the difference between what a discount point is and an origination point? Because you've all bought a lot of properties. And I'm not surprised to hear that a lot. Don't feel bad. Most people don't know the difference. It's one of my YouTube videos I'm making right now. It'll be great. An origination charge goes directly to the lender. It actually means that the interest rate that you're getting has nothing to do with that origination charge, right? A discount point can only be charged, RESPA states on the closing disclosure, if you're buying down your interest rate, it has to be listed as a discount, right? It's actually paying that spread on that interest rate. You have to be careful with that. There's some lenders right now that charge origination fees, and you think you're buying down the interest rate, and you're not. They're very well associated with spaceships.
Sam, you also mentioned that upfront mortgage insurance.
Yep.
What is that, like upfront mortgage insurance?
So upfront mortgage insurance comes into play with FHA financing. I can't believe my hands in my pockets. My God. So FHA financing has mortgage insurance, right? And you're familiar with PMI on conventional loans. PMI is the acronym for private mortgage insurance. It's issued by a private company, right? So they insure 20%, the difference between your down payment and that 20%, because the bar has been set for banks that the cover to the cost of recovery from a foreclosure is 20%. So if someone puts 10% down, the PMI is insuring the other 10% so that the bank doesn't lose when they foreclose on the property and sell it. Government loans are, FHAs are loans that are insured by the government, not a private company. So it's you never, since I have a stage here, I can share all this without you because you're a captive audience, but I mean, you never want to confuse people, but at the same time, it's on FHA, it's not PMI, it's called MIP, mortgage insurance premium. It's because it's the government's issued policy. You have a monthly amount that you paid, but which they did lower recently. It's come down quite a bit, which is great. Over 22 years, I've watched that go up and down. But you also have an upfront mortgage insurance. And the upfront mortgage insurance premium is 1.75% of your loan amount. So it's almost 2% of the equity in your home. And it's financed, so most people don't complain. They're like, okay, great, you're going to finance that. I don't have to pay for it now. I'll worry about it later. But when you sell, you're technically out that 2%. It's not necessarily a bad thing. It's to fund FHA loans, which have this tremendous surplus right now and actually don't need it. So it's really interesting. And you mentioned VA earlier, right? So FHA insures, VA guarantees. So they're two big difference. It's not insurance because there is no monthly insurance on a VA loan. And also with VA loans, you can take multiple out. You don't have to wait until you've paid one down. You have a set entitlement that you can use with VA financing, and you just have to recalculate what that entitlement is for the next property, which is great. It's my favorite loan product that exists, actually. So upfront mortgage insurance is a premium that you pay up. It has no impact on your monthly amount either. You still pay that monthly mortgage insurance as well. In most conversations when I'm talking with clients about conventional versus FHA, I just say mortgage insurance. I don't say MIP because it's kind of a jerk thing to do anyway. Someone's like, PMI. It's not PMI. It's MIP. What? That's 10 minutes. 10 minutes talking about it. It's like, okay, they don't really care. It's mortgage insurance. As far as which?
Comparing PMI to MIP.
So MIP is set, right? It's a factor. It's a set 0.55 factor. It'll go down if you put 5% versus 3.5% down. And this is what I was talking about earlier. I'll go back to what I was going to talk about earlier. I got sidetracked. So PMI is based off of how much is insured. Your credit score is another big factor. If there's two borrowers, it's cheaper, actually. More two people on the hook, I guess, right? So with strong credit, then PMI is cheaper. Credit's not great, and right now that means a 720, then MIP is probably cheaper. But it still doesn't mean FHA is a better scenario because FHA still has that upfront mortgage insurance premium as well. So it just depends.
Is it fair to say that over the life of the loan that they're somewhat equal? Or is that not a fair statement?
It's not a fair statement because conventional, which is PMI, can be eliminated when you have 20% equity. Technically, it will be removed automatically once you have 22%. Once you get to 78% of your loan versus the value of the home, the PMI can be removed. FHA is for the life of the loan. Unless if you put 10% down, then it'll come off after 11 years. Exactly, after 11 years it'll come off. So it's not really a fair comparison because chances are you're going to get rid of PMI before you would get rid of MIP. Traditionally what we'll look at is clients will use FHA loans to buy using the lower down payment, and then we'll refinance into a conventional loan once they have the value. I've been doing that for some clients recently. We stopped because the rates are so high it actually doesn't make sense anymore. It's like, all right, it doesn't, because actually I have a pretty big cachet of pre-approvals of people who've come to me for financing that haven't. Maybe you're surprised to find they can't find a place. So they've been around for a long time and they're just excited over the conventional option, right? Because they were going to refinance, we haven't done it yet, they were going to refinance their FHA loan into a conventional loan so that they could use an FHA loan again and put less down. And now they don't have to do that, which is, at least they shouldn't have to do that, which will be great. Because they can use 5% down and use conventional financing. So.
The difference there is you don't have to do any finance, conventional financing.
Right. And you don't have to refinance at any point anyway, but.
That's a misconception.
How so?
Because I've been in the same property. Well, first off, let me ask, because I just may not be meeting the rules. What are the values based on? what is the 80/20 based on? Is it based on the original mortgage amount and what you paid for the property? Is it based on actual value? What are the parameters for?
So it depends on your loan servicer and who's holding the servicing to it. Within the first 5 years, they might hold you to, on a multi-unit, right? They might hold you to where you need to have 35% equity before they'll remove the private mortgage insurance.
I was speaking on a single family.
A single family home?
Yeah.
No, you should be able to have your PMI removed. They can't.
Based on what what are the parameters?
The
Is it
current
original
market value.
Okay, and then in order for them to drop it automatically, they've got to have an appraisal for current market value.
No, for them to drop it automatically, it means that your amortization schedule, the balance on your loan, is at 78% of your original purchase price.
Okay.
In order for you to cancel the PMI, you'll either have to have an appraisal done or they'll run an automated evaluation method to determine if you have enough equity there. So it's going to be based off of a third-party determination of the value, and you have to have the equity there.
So I've got 5 mortgages with Chase and never been able to get PMI removed on a single properties that I've owned for 20, 30 years.
You've got to be kidding me. Conventional financing? How?
They want me to pay $400 for an appraisal.
Why didn't you pay $400 for the appraisal?
Not going to do it, just out of principle.
Have you spent more than $400?
You should have just dropped it.
I get it, but have you spent over $400 in PMI?
Oh, I've spent a lot more. A lot more. I'm stubborn.
So the nose,
I do
don't
some
cut off your
things-
nose to spite your face.
Yes, but I do some things out of principle. And
I get it. No, that's honorable. I think it's great. You know what? I like that. It's what works for you.
Plus, I've got 30 accounts with Chase, different, through different businesses. I love to support Chase. I'm giving them extra.
I think that's great. They love that. JP Morgan, Jamie Dimon is actually probably going to come buy you dinner. He's an outstanding individual.
Keeps calling that I keep,
Chase is, unfortunately, Chase is not, I'll say it, they're not good at lending. They're great. I bank with them. I'm a private client. They're good with managing my accounts. They have one mortgage that was with them back. I'd gotten into it. And actually, I had to modify it back when you could do. I don't know if anyone remembers when you had HARP loans and you could refi plus. These were terms we used. All right, so there was a time where you could refinance loans without an appraisal and all costs, and it was great. You could get a much lower interest rate, and it was wonderful. But you had to go through the original servicer, so I had to go through Chase for it. And I literally was teaching them how to do it. It was insane. It's like, oh my, wow. I couldn't imagine someone who doesn't, because I actually know the industry. But you got to Karen out on this a little bit. Like, you know what I mean? You got to talk to the manager. Like, get your principals.
I talk to the managers probably 3 times a week.
Talk to a different manager. Yeah, keep going.
That's just one
Yeah.
small problem.
I couldn't, because I'm with you. I'm a principles guy. Like, I'm totally, I really do mean it. I think it is good. But I couldn't sleep at night. I wouldn't until I stopped, because I would know. I'd be like, but the problem is if they require a third-party appraisal to remove your PMI, you can't argue their guidelines. That's their right to determine that, and I guarantee you it's somewhere in the stack of 742 pages that you signed. So you got to go through, and you just have to look at it, and will they accept a third-party appraiser? Can you pay someone else yourself and have it done? Most likely not. But I would do it.
And I believe that if you've refied, even though it's with them, and they refied you just to lower your payment and lower your rate, then that resets everything. But
No.
I don't know what it resets to.
Depends. So that's and I think I'm glad you brought that up, because a lot of people don't realize this as well. So when you refinance a loan, you don't have to refinance for 30 years or 15 years or 20 years. You can refinance. Now, it can round up to the nearest year. So if you're 1 year into your loan, let's just say that you're calling me and you're super pissed because you paid 4 points and rates dropped and it's only been a year. But it won't be that hard of a pill to swallow, because we're going to lower your payment. You're going to be super happy. All right. But, we could put you into a 29-year loan. You don't have to step back on your repayment period. But if you do elect to step back on your repayment period, just remember that you're starting with your loan amount currently, not your original loan amount. So you are paying interest by spreading it out over 30 years, but at the same time, you're paying it off of the lower amount that you balanced.
But if
So-
they didn't do an appraisal on the property when you refinance, been with them, I'm a good example. Been with them for 30 years, owned several
they like you.
properties with them. They, quote, did the appraisal in-house.
Yeah, they do no, it's an automated evaluation method. And we use them now openly on purchase transactions and everything. So Fannie Mae and Freddie Mac have developed algorithms to determine the property value based on the data that's there, along with your personal data to determine if an appraisal is necessary. When you buy a home, an appraisal is to determine if that property is worth the collateral. It's for the bank. So you pay for an appraisal when you buy a home, but it's for us. It's to tell us that we're safe lending the money off that. So now there's been methods determined that may not be required. But Chase has their own evaluation method that they're going to run. It's going to say, okay, yeah, this property has the equity there.
And if you don't ask enough questions, like, okay, what did you reappraise the property at? You still don't know when that.
Well, they'll probably say they
8% is
didn't.
gonna be.
They'll say we didn't reappraise it. We just have determined that you have a sufficient equity position, so we're comfortable. And Chase also can modify the loan. They don't even have to refinance it. They can just modify it and change it.
So in that
Change it completely.
instance, you're thinking it's still based on the original value.
Right.
Which it isn't necessarily, and I'm not gonna say by the purest letter of that 700-page document that you referenced.
Right.
The big problem is that getting to the person who can say yes, that you qualify in here, we're gonna just do it. That's the big problem. Because you can speak to 15 different people, the left hand doesn't know what the right hand's doing.
I would just keep going and going and going and going. Because I also cut my nose off to spite my face. Because at some point I'd be like, wow, if I just paid for the appraisal, I could have made more money doing other things than the time I spent on this. But I would do the same thing. But I wouldn't give up if I were you, because you probably have low interest rates on those, so you can't refinance out of it.
Well, they're almost paid off anyway.
Well, there's that.
Close to it.
That's so absurd. They're almost paid off, and you still have PMI.
Yeah, I've got PMI on a property that I paid $130,000 for, and I owe $30,000.
I'm sorry to hear that.
PMI.
I'm sorry to hear that. Well, traditionally, you should be able to have the PMI removed at any point in time within your first, depending on if it's Fannie or Freddie, and I don't want to give you the wrong information on which one, you could technically get locked in for 2 years on PMI. So,
Unless you are related to Jim Biggs.
yeah.
No, I think you just.
If you go the first year, so the standard procedure is that within the first year of buying a property, if you pay the balance down and you have 20% equity based, not 22, if you have 20% equity within the first year based off the original purchase price, not the appraised value, the PMI will be removed immediately. You can demand to have it removed. Going into year 2, you could pay it off 50% of your loan off, and they have the right to keep it. I have clients who have successfully removed it. Same thing with an escrow account. When you close on a property with an escrow account, technically they can force you to keep it now for 2 years. I changed that guideline too, because I had so many clients you have to pay. A lot of people don't realize this. When you don't escrow your taxes and insurance, if you have that right, in most cases you're paying for that. Lenders don't talk about it, but you're either getting a higher interest rate or you're paying a fee for it because they charge for it. It's a cost. No one's doing anything for free. And it's funny because people don't realize that. Well, a good trick that I would do is I would tell somebody, like, look, keep the escrows on, you're going to close, and then before you make your first payment, you're going to call and you're going to tell them to remove the escrow. They can't stop you. And they couldn't stop you. And then one day they could. And now, I don't know if it was me personally, but I feel like it was, kind of. I think I pumped a lot of loans through them doing that, and they were just like, oh, we don't like this. So, because banks make money off of lending your money, right? I did a video recently that contradicts what everyone thinks about paying down. We were talking about paying your loan off a 30-year, paying it off in 15 years. I wouldn't do it. I wouldn't pay biweekly payments right now. I wouldn't give $1 above what I have to on my set amortization schedule because it's not compound interest. It does not, regardless of what you see on TikTok and these people writing stuff down, it does not change how much interest you pay monthly. You will pay that same amount until your loan is paid off. You take your loan out, you have your principal, you have your interest. And it's a set schedule that will pay that loan off until you're down to zero. When you put additional money towards your balance, it comes up from the bottom. So you pay the same amount of principal and interest until they meet. So yeah, you didn't pay this interest, but you paid all that interest up front. So instead, take your money and go put it into U.S. Treasuries. They're paying over 5% right now. Put your money into high yield accounts. And let's just say for some reason 18 years does pass and rates don't go down, and you've earned all that money. Well, you want your loan paid off in 15 years? keep the money yourself, make the interest on it. Don't let the bank lend your money out. You make the money on it. Now, technically, they're lending it out when you get paid. Just get paid for them to lend it out. How's that? But in 15 years, pay your loan off, you're gonna have a hell of a lot more money in that account than that amount that you put there, right? So it's like people are like, oh, I want to pay an extra payment. I want to pay this off quickly. I'm like, don't. Like, it's a bad idea. And some people are like, it's just how I am. It's just what I want to do. And I'm like, okay, great. That works for you. Then do it. But would you agree that this is a way you might be able to benefit financially?
Is that a hard and fast rule, Sam, or is there
Which one?
Can you negotiate a bi-monthly payment where that is coming off of the?
No, it's hard and fast. Yeah, standard amortization schedule. It is standard. So a lot of, and in defense of some of the people that do videos on different platforms that you see about that, they're usually Canadian, or you're dealing with European systems. They're dealing with a different system where it actually is not set up that way. It is compound interest. It's different. So it's a little bit, they're not trying to collude the U.S. population. It's just unfortunately the U.S. population doesn't understand the difference. Why would they? Why should they?
I have just one quick question.
Please.
Anyone here lately had an escrow adjustment because their property taxes went up?
Yeah.
So we had an escrow adjustment. Our mortgage payment went up because of that, because the escrow account required more. But then for this year, we actually qualified for, they were able to appeal and come to a lower assessed value.
Mm-hmm.
But with that being said, were there ever times where that escrow adjustment that went up, does that ever go back or down?
Yep. So an escrow account is federally regulated. Okay. And this is great. This didn't happen when I first had my first property, that condo I bought back in the day in my house over here. I hated escrowing my taxes and insurance because they weren't regulated and managed well. So your loan could get sold to someone and they could tell you owe them money because they need an additional cushion, 3 months, 6 months, whatever they want. Federally regulated now, 2 months at any given time, and they have to run an annual analysis on your escrow account to determine your taxes, and they can never keep more than 2 months worth surplus, right? So you're going to get that money back. Now, when your taxes go up, right, what happens is the bank pays them for you. You know why the bank does that? Kind of. So yes, you're not wrong. A tax lien supersedes a mortgage lien. If a property is foreclosed on and there are outstanding taxes, the taxes get paid first, right? Banks don't want that. That was originally a big driver on an escrow account. Like, they do want to use your money and lend it out, but they also want to make sure your taxes are paid, because that was a problem. There was a time where that was a real problem. So, going through and looking at that, your taxes go up. When your taxes increase, the bank will pay them for you. And they're going to say, okay, we paid I'm going to use simple math. I'm a simple guy. $1,200, your taxes went up. So your mortgage payment just went up $200. You know why it went up $200 instead of $1,200? That should be $100 a month. Why do you want $200 from me? This is bullshit. This is my real me really on the phone. I'm in this like year 8 in this business thinking I'm the man. So it's like, do you know who you're talking to? Well, my name's Sam, and it's like, no, genius. It's because we have to make sure there's enough in the escrow account, and your taxes did go up $100 a month, and we want our $1,200 back. So now you're in a position where $200 a month is being paid out. After 12 months, your payment will go down $100. It will maintain that higher level to pay the tax bill. Your tax bill goes down, now you're going to get a refund check, and your payment's going to go down. If recently, when the tax bills came out, you're with his buddy Chase, there was a huge error, and they basically more than doubled the tax take. So I got just berated with phone calls from people like, my mortgage payment just went up from $3,000 to $7,200. What's going on? Like, that was a real number. I was like, I was like, no, it didn't. Like, it did. Send me your statement. I'm like, it did not. And if it did, there's a mistake, right? And it was a problem. The benefit, though, what was really cool is that they made this mistake, and all my clients that this happened to, I coached them all to do the same thing. They went to a Chase branch. Fortunately, they're in a position. They went in, they paid the shortage, and they canceled their escrow account. They're technically within the 2 years that Chase wants it. And I said, listen, just go cancel. I said, you're hurting them more than you know right now because they really need the deposits. Like, just go cancel your escrow account. But yeah, so they had a big problem. But when your taxes go up, your payment goes up to pay the new increased taxes as well as the shortage over a 12-month period. Fun fact that I just learned, if you are having a hard time and the payment's gone up and that 12-month spread is too much, ask them to extend it. You can actually get it extended for up to 60 months, so 5 years. They're never going to tell you that, but it's true. So it's a majority of all the loan servicers will do this for you. So that's something I just learned about. There was a mortgage people get together and they talk, like the people who are my boss and their boss's boss, they talk, and this is something that they recently were talking about, was that the servicing rights. And some people are going to need that because property taxes will keep going up because the values keep going up, and they need that help, so that's a good thing.
Yeah, I mean, ours went up 30% last year.
Yeah.
And our loan got sold from, I think it was Wells Fargo to
Mr. Cooper.
Super.
Marketing at its finest. You know that was Nation Star, right? Does everyone know that? Mr. Cooper was Nation Star.
We received the letter in the mail, and our escrow adjustment came in. Our mortgage payment went up $1,000 a month.
Yeah.
Well, there goes our cash flow.
Right, like that kind of hurt. Oops.
But you're saying that like this year we qualified for, we have to look at this year and the assessed value went down, so there's a chance for it to potentially go down.
Yeah, I mean, if they went up $1,000 a month, I'd be willing to bet your taxes didn't go up $12,000 a year, unless there was a senior exemption or a freeze or something on it before. So chances are they might owe you more money than that, and you really want to sit down with someone and make them do the. You can go into the branch and ask them to do the escrow analysis on the spot. They can't deny it.
That's if the servicer hasn't.
Yeah, good luck.
Right. It depends on. Well, but I mean, it depends on the bank. Who you say they sold to Mr. Cooper? Yeah, you can't walk into Mr. Cooper's house. That was genius marketing. It really was. Everyone knows who Mr. Cooper. Everyone's like, Mr. Cooper. That's the stupidest name I've ever heard for a mortgage company. Like Nation Star apparently wasn't performing, so they changed their name to Mr. Cooper, and all of a sudden everyone knows who they are. Pretty crazy.
So you mentioned like industry mortgage meetings and the executive. What
Sure.
Talking about that, in the industry. So obviously, these are the proposals now, the 5% 2 to 4 to help people, affordability, buying the rates down. Are there any proposal out there where the mortgagers or people are proposing to Fannie Mae and others to like 40-year mortgages or anything like that? Is that
Yeah.
being brought up? Like, what's your thoughts on what other programs that have come up to relieve the kind of monthly payment? People buy on payment; they don't buy on a price.
Did you know in China they have a 100-year mortgage?
I'm not surprised.
They don't. You don't. Well, we're very lucky. We buy homes. I said this at at the event, at Bree's event. I said the same thing because I believe it. We buy homes like people buy Toyota Camrys. Like, in there are countries where they don't buy homes. Their families and generations buy homes. It's not affordable. Like there are other economic models that we can see that are going through similar things that we're experiencing now that have led to these situations, right? Like the idea of our right to own a home is not exactly as solid as you would think. And that was what I was talking about, the buy downs. The reason I am talking about the buy downs is because from 75, when that 18-year period, there were 3 recessions. Recessions do not mean interest rates go down, regardless of what clever video you see. It doesn't. If you go look, there were 3 recessions, and the biggest driving factor on interest rates was inflation. Have you heard of inflation? Anyone heard of inflation lately? No? Yeah. Inflation. Oil crisis. Iran oil crisis. Right? Do you think of any reason why we might have a problem with oil coming up already? I mean, there's real driving factors that could impact that. So. Appreciate it. Thank you all.
Sam, thank you so much.
Thank you very much.
Yeah, appreciate it.
Awesome stuff. All right, guys, give it up for Sam. And before we start our networking, just want to do a couple housekeeping items. The first one is we have our holiday party that we wanted to announce. We have that in the books for December 14th. So for those of you guys who are interested, do we have an event on Eventbrite or not?
There is an event on Eventbrite, but if they do the sign-in sheet, the link will be there once they submit.
Perfect. So for everyone here, make sure you scan the QR code, sign in, put your information on there, and at the bottom you have more details regarding the holiday party we have on December 14th. So we hope to see you all.